You are asking the right question about bonds, and you are right to be skeptical of the high yields you are seeing. The real problem is that many investors mistake a high coupon for a guaranteed profit, not realizing they are holding a trap that could cost them their principal if rates shift. By the end of this video, you will understand why bonds are not just static income machines, but are actually the most powerful dynamic tool for rebalancing your portfolio when the market turns against you. For years, the conventional wisdom has been simple. If you want safety, you buy bonds. If you want growth, you buy stocks. If you want high returns, you chase the highest yield, which usually means buying lower quality corporate debt. This logic suggests that the only difference between a safe government bond and a risky corporate bond is the spread, the extra interest you get paid for taking on more risk. But recent research into the structural mechanics of debt suggests this view is dangerously incomplete. It misses the fundamental friction that exists between how banks lend and how bonds are traded, especially when things go wrong. Here is the thing that changes everything. When a borrower gets into trouble, the difference between a bank loan and a bond is not just the interest rate. It is the speed at which losses can be allocated and the efficiency of the resolution process. Bank loans are held by a small, concentrated group of lenders. They know each other, they can meet quickly, they can coordinate a restructuring or a liquidation without the chaos that comes from trying to get thousands of dispersed bondholders to agree on a single plan. This coordination friction is a massive hidden cost that bond investors often ignore until it is too late. Because of this structural difference, the bond market behaves differently than the bank loan market during times of stress. When interest rates are rising, banks can adjust their terms more fluidly. They can renegotiate covenants or demand additional collateral much faster than the bond market can react. Bonds are designed for stability and predictability, which makes them rigid. This rigidity is often viewed as a weakness, but it is actually the source of their unique utility in a falling rate environment. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. Consider what happens when interest rates begin to fall. This is the scenario where bonds truly shine and where most investors miss the opportunity. As rates drop, the value of existing bonds with higher coupons rises significantly. This is the concept of duration. Duration is a measure of how sensitive a bond's price is to changes in interest rates. A bond with a longer duration will see its price jump much more than a short-term bond when rates decline. This price appreciation is not just a nice bonus. It is a mechanism that allows you to generate massive gains without selling any of your other assets. This leads to the most critical insight for your portfolio strategy. Many investors think of bonds as a place to park cash while waiting for better opportunities. They treat them as a static income source, collecting coupons and waiting for maturity. But in a falling rate environment, bonds become a shock absorber. They act as a dynamic buffer that allows you to rebalance your entire portfolio without having to sell your equities at depressed prices. Imagine a market downturn where your stocks have lost significant value. You need cash to buy those stocks back at a lower price, but selling them now locks in your losses. If you have a portfolio of long-duration bonds that is appreciated in value due to falling rates, you can sell a portion of those bonds to raise cash. You buy the dip in stocks, and you keep your bond holdings intact or replace them with new bonds at the lower yield. You have effectively used the bond market to finance a strategic equity purchase without depleting your cash reserves. This is the dynamic rebalancing that transforms bonds from a passive income stream into an active risk management tool. The research into the bank bond margin reveals a deeper architectural failure mode that makes this even more important. When rates rise, collateral mismatches can force fire sales. If you rely too heavily on high-yield instruments that are illiquid or poorly structured, you may be forced to sell assets at a loss to meet obligations. This is the value trap. You get a high yield, but when the stress hits, you cannot access that value efficiently. Bonds, particularly high-quality treasuries, act as the ultimate collateral in the financial system. Their liquidity and safety profile enable leverage management that high-yield instruments simply cannot support. This shifts the entire perspective on why you hold bonds. It is not just about the yield you earn today, it is about the flexibility you have tomorrow when the market turns. The ability to quickly adjust your duration in response to the rate curve serves as a dynamic hedge that outperforms high-yield traps during market downturns. The structural role of bonds is defined by their negative correlation to equities during crises. When stocks crash, bonds often rise. This inverse relationship is the key to the buy-the-dip strategy I mentioned earlier. However, there is a caveat to this dynamic. The research shows that even minor wedges in recovery rates can create sharp cutoffs in how investors behave. This means that institutional reforms do not always yield linear shifts in debt composition. The utility of bonds is highly sensitive to the specific insolvency regime and the coordination frictions I discussed earlier. If the system for resolving distress is slow, the bond market can freeze up. But for the individual investor, the takeaway is clear. You must stress test your bond portfolio for liquidity efficiency, not just yield optimization. You need to look at your bond holdings not as a collection of coupons, but as a strategic buffer. Are they liquid enough to be sold quickly if you need to rebalance? Do they have the duration to capture the gains from falling rates? If your answer is no, you might be relying on a static view of a dynamic market. The most successful investors are those who treat bonds as a tool for systemic stability and portfolio rebalancing rather than just a place to hide money. By understanding the structural trade-offs between bank loans and bonds, and by recognizing the power of duration in a falling rate environment, you can stop chasing high yields that turn out to be traps. Instead, you can build a portfolio that uses bonds to protect your wealth and fund your next strategic moves. This is the shift from passive yield capture to active risk mitigation. It is the difference between surviving a market downturn and thriving in it. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.